Good afternoon, everyone. Once again, thank you for joining the G20 OECD Corporate Governance Seminar. My name is Tomohiro Takeda of Japan's Financial Services Agency. I will serve as the MC for the rest of this seminar. Now, we will start session 2. The topic is corporate access to finance in a new capital market landscape. Let me introduce the chair, presenter, and panelists. Please proceed to the stage in the order you're introduced. The chair is Mr. John Plender. The presenter is Mr. Masato Kanda. The panelists are Mr. Ligan Liu, Mr. Carmine Di Noia, Ms. Barbara Novick, and Mr. Hiromichi Mizuno. Mr. Plender, the floor is yours.
Thank you. Well, good afternoon, everybody. It's a great pleasure to be invited to moderate this session of the seminar on corporate access to finance in a new capital market landscape. The format of the session will be that Masato Kanda, who's the chair of the OECD Corporate Governance Committee and Deputy Director General of the Budget Bureau of the Ministry of Finance here in Japan, he will give an initial presentation. We will then turn to our panel, which consists of Ligan Liu, Managing Director and Chief China Economist at Citigroup in Citigroup China. We then have Hiro Mizuno, Executive Managing Director and CIO Government Pension Investment Fund of Japan, which is the biggest pension fund in the world. Carmine Di Noia, Vice Chair of the OECD Corporate Governance Committee and Commissioner of CONSOB, Italy, which is the Italian securities watchdog. And then we have Barbara Novick, Vice Chairman and Chief Executive Officer, and indeed co-founder of BlackRock, the biggest US fund manager. So there is a lot of money represented on this panel. But first of all, let me turn to Masato Kanda and invite him to map out the subject matter of our session.
Thank you very much, John. First, I'd like to express my sincere thanks to the distinguished moderator and speakers. I also appreciate the participation of wonderful guests joining here. Very much welcomed. As the chair of the OECD Corporate Governance Committee, I am very grateful for your support of this seminar. Peer learning is the foundation of our committee, and I am confident that today's discussion, led by top-notch experts, will provide great insights and lessons for all of us. My role here is to present key trends and changes in today's capital markets. Hopefully, this provides some food for thought for the coming discussion. Let me start with the global shift in IPOs. Over the last 2 decades, there has been a downward trend in non-financial companies' use of IPOs. In advanced economies, the average annual number of IPOs by these companies has fallen from about 1,260 in the late 1990s to 550 since 2008. This is particularly significant for smaller non-financial companies. Since 2008, IPOs below $100 million have significantly declined in the EU and the US, which is highlighted by Mr. Talbot a moment ago. This downward trend in advanced economies stands in sharp contrast to development in emerging markets, particularly Asia. Corporations in Asia have drawn the most funding through public equity market in recent years, rising $4 trillion since 2000. In the early 2000s, companies in Asia accounted for 21% of global IPO proceeds. This rose to 43% in 2017. Half of the world's 50,000 listed companies are now on Asian stock market Asian stock exchanges, and this represents 40% of total global market capitalization. When it comes to growth companies, the number of IPOs in China has increased to levels seen during the rapid growth of startups in the United States market at the end of 1990s. These developments raise several questions. One is, what can we do to give fast-growing companies more access to public equity markets? With this in mind, as Matt mentioned in the previous session, we released the thematic peer review last November titled Flexibility and Proportionality in Corporate Governance, which explains how countries design their regulation to meet the needs of entrepreneurs and corporations in different business environments. As an example, some countries scaled disclosure requirements to promote capital market assets for fast-growing companies. A clear message from the peer review is that for flexible regulatory approaches to work, they should be backed by solid judicial and supervisory foundations to protect the rights of different stakeholders. Another important question is why are fewer fast-growing companies going public? One theory is that global platforms like GAFA, Google, Apple, Facebook, and Amazon are buying up these companies instead. For instance, The Economist reports that Alphabet, the parent company of Google, has spent $12.6 billion investing in 308 startups since 2013. By the way, John is here. The decision as to whether to go public, of course, rests with entrepreneurs, of course. But we need to keep in mind that public equity markets give a wider population the opportunity to reap the benefits of growth. Public equity markets also play a crucial role in the efficient allocation of capital if more and more corporates circumvent well-regulated and accessible financial markets. The efficiency of capital allocation may be reduced. Furthermore, this may raise the question whether market regulations could be less effective. How should we address these issues? Another important trend has been a shift in the ownership structure of listed companies. We have conventionally thought about ownership structure as a dichotomy of concentrated versus dispersed. But we should go beyond this as there is much greater diversity in these days. This is important as policy decisions may differ depending on whether controlling shareholders are institutional investors, holding companies, or strategic individuals. Concentrated ownership has made inroads in advanced markets where dispersed ownership had been more prominent. Almost 85% of listed companies worldwide have a single shareholders with more than 10% ownership. And next one. Taking a closer look at a sample of 35 jurisdictions, in 30 jurisdictions, the three largest shareholders hold more than 40% of a company's equity capital on average. The market with the lowest concentration are the US, UK, Canada, and Japan, as measured by the combined holdings of the three largest shareholders. However, among these four, the top 20 largest shareholders own, on average, between 50 and 60% of company's capital. For these countries, institutional investors play a large role in the concentration of ownership. In the United States, the 10 largest institutional investors hold on average more than 30% of the average company's capital. This is followed by the United Kingdom at 20%, and the role of institutional investors in public equity market has increased worldwide. assets under management by pension funds and insurance companies in OECD countries more than doubled between 2000 and 2017, reaching 58 trillion US dollars. It is worth noting that the rise in the importance of institutional investors has been accompanied by greater use of passive investment. In the United States, this statistics is limited to the mutual funds, but in the United States, ETFs and index funds have grown from 1/3 of the value of equity funds in 2013 to just over half in 2018. Driven by the emergence of sovereign wealth funds and growing role of public pension funds, the public sector has also gained a growing presence in equity markets. Indeed, the second largest ownership category in stock markets is the public sector, with 13% of global market capitalization. Importantly, more than 8% of the world's listed companies have over 50% public sector ownership. These trends require us to discuss, among other things, how to ensure constructive engagement by institutional investors, how to protect minority shareholders' rights given more concentrated ownership, and what are the implications of these trends for public sector ownership. This was a brief overview of the changing or transforming landscape in capital markets. I look forward to our panelists' insights on these emerging issues. To conclude, while much progress has been done on the implementation of the G20 OECD principles of corporate governance, policymakers cannot be complacent and need to stay aware of these radical changes in capital markets. The OECD Corporate Governance Committee is committed to providing solid analysis on these topics as a basis for these discussions, as evident in their factor book Mr. Guria presented just a moment ago. And I'm sure that today's seminar will be important contribution to the global agenda and to better corporate governance policy. Thank you very much indeed.
Well, thank you very much, Masato. There's a lot of food for thought there. And I'd like to kick off, if I may, by turning to, first of all, Mr. Mizuno, and ask you, how worried should we be about the reduction in IPOs in the developed world? Because when I first saw those figures, I mean, it occurred to me that, in a way, they reflect a change in industrial structure. If you look at Silicon Valley, if you look at the more advanced sectors of the economies of the developed world, these are not capital-intensive businesses, and they come to the market essentially to give an exit to venture capitalists and to provide a currency for acquisitions and mergers. So should we really worry that much, or do you think that there are enterprising smaller companies that should be coming to the markets and are not?
Well, thank you very much. I really enjoyed your presentation, and I was trying to think what I should say, and you gave me quite a challenging question to start with, but I'll try to address your question. GPFs, we now own 1.5 trillion US dollar public pension assets, and we probably the largest, the asset owner in the world, and I sit next to the largest asset manager in the world, and we regard we are the root of investment chain. We own the asset, and the asset manager manages our asset, but the actual asset is created by corporate. So the chain consists of asset creator, asset manager, and asset owner. So we think these three actors and actresses have to work together to achieve something long-term, or like have a more market-wide systemic effect. So we have been working very closely with asset managers, including BlackRock, to make sure that we share the same investment time horizon, just to make sure that we are not going to be paying only attention to the company we own, but we also pay the attention to the sustainability of the whole capital market. So that's the sort of background of all our approaches toward the market. And to your question, as probably one of the biggest owner of the public equity market, I'm concerned about that the phenomena that we see the deduction or decline in IPOs. maybe a bit for different reason than people think. It's not only about IPO, but we also observe the reduction or decline in the number of the publicly listed companies. And in the US, now the company owned by private equity funds are much more than publicly listed companies. And we need to find out why, because public market give much better access to general public, including pension fund, to benefit from economic activities or growth of the economy. So I discussed this a lot with the other asset owners, and a big asset owner think, well, I have a good access through the private equity fund, but private equity investment is very expensive. So public equity market provide much better, less costly opportunity for everybody to benefit from global economic growth. So I think we should pay attention to how to keep the public market healthy. And if you think about I have to think about what's going on, why the reduction in the number of the listed companies. And the one thing I found out is when we discuss with the other asset owners, everybody says, oh, we are now increasing our allocation to private equity because public equity doesn't provide better return and it has been so volatile. So the asset owner want to have more private assets. And if I talk to the corporate executives, they want to be privatized because they think the public equity market is giving them too much unnecessary short-term pressure. And they feel like, it's not only Elon Musk who really wanted to be privatized. And now the public private equity funds have enough capital to privatize reasonably, some sizable listed companies. So when you face the situation, corporate executives don't want to stay in the public market, and the investors prefer private market because they think they can get a better return. We are facing this trend, and the question is, we try to do something to reverse it or not. And GPIF, I think, when we joined the journey of fulfilling our stewardship responsibility when we signed up to the Japanese Stewardship Board, we need to figure out how we can fulfill our stewardship responsibilities. And we decided or concluded by promoting ESG investment, we actually fulfill our stewardship responsibilities, because the one of the issue we need to address is corporate governance should be better, but if we really don't see the reason why we want to have the good corporate governance at the corporate level, it only put the unnecessary pressure on the corporate executive, and they feel like they want to be privatized. So corporate governance should be the foundation to secure long-termism at the corporate executive level as well as the investors. So I think that by promoting ESG, environmental, social, governance issues, we are trying to create the framework or environment where investor and a shareholder as well as a corporate executive feels like they have a long-term agenda, and the corporate governance should secure the corporate executive can focus on the long-term issues, because there are a lot of short-term incentives, not only on a corporate executive level, also at the investor level. We have short-term incentives. So without the good corporate governance in between, we face the short-termism on the investor side as well as the corporate executive side. And I think that's the kind of some background reasons why we see the deduction in the listed companies. And it's not going to work and in favor of long-term, more inclusive capital market. And GPF is representing every single Japanese, the sweat money. And I think we should keep the public market healthier and inclusive and sustainable. So that's the whole the reason behind our push of the ESG integration throughout our investment chain.
Could I just a very quick one? Is in part the fashion for private markets really a case of part of the search for yield? Because if you go into the private markets, you can harvest an illiquidity premium, albeit at the cost of higher risk and higher charges. Do you think there's an element of that in it?
Well, before I took this role, I was a partner of private equity fund. So I used to sell the private equity fund saying it creates much better return and has very little correlation with the other public market. And very importantly, it has very little volatility. So the public market, investing in the public market is a roller coaster ride. And, but in the public market, in a private market, you are not facing like a daily evaluation by the, the market forces. So it's not only about return, and the return you cannot really, challenge it because they deliver better return. So it's a much better proposition as an investment, the product. But volatility, we have to think why we are creating so much volatility in the public market. Is that because the investor becomes short-termism? Or is that an investor promoting short selling? Is that because we have been so aggressively, coming down on the corporate management to solve the short-term, the profit goals? And all those kind of things we need to be solved. But it's not only about return, which make the private investment more attractive to asset owners or investors.
Okay, thank you. Well, let's turn now to Barbara Novick of BlackRock. Are you concerned that many large companies, the so-called unicorns, come to the public market relatively late or stay private? And do you see any role for institutional investors in promoting companies' use of public capital markets?
Okay, first of all, thank you very much for hosting and for inviting us to participate. I want to tie some of my remarks back to the prior panel and look a little bit more holistically to answer your question. And the way I think of it is you've got sort of a scale, and you've got the public markets on one side and the private markets on the other. And you have to look at what are the causes or what are the components that are encouraging the companies to go one direction or another. And I would say there's a number of things that are global issues, and then there are some that are more regional. So at the global level, we have set a higher bar for public companies than for private companies. And that higher bar includes increased reporting. It includes more shareholder engagement, which in many cases are good things. Don't think of them all as bad, but they are things that you have to recognize as a public company as costs and costs of doing business. We have constant scrutiny. If you look at the media focus on public companies versus private companies, the same with NGOs, politicians. To be a public company is not an easy thing today, and you get your share of inquiries. You also have a expectation today that somehow, and this is somewhat a reflection on the political climate, somehow public companies are going to solve every problem in the world. And of course, that's, again, a high bar. The reporting I mentioned, compensation, the discussion you heard earlier, focused on compensation. You don't hear that in the private companies, the shareholder proposals, and then activists. Right? Noticeably an uptick, especially here in Asia, of activists coming in and very much trying to change the companies. So again, if you're a public company, how do you feel about that? Heath mentioned earlier the US Treasury report on capital markets and some of the things that were identified there, Sarbanes-Oxley and the certifications, the litigation risk. Think of something like Bayer, Monsanto. Again, if you're public, how much of a target you become. On the EU side, some specific things, the Shareholder Rights Directive, requiring companies to submit compensation to shareholder votes in different ways than in the past, additional transparency, the non-financial reporting directive, and of course, here in Japan, the new stewardship codes, and how far do those go? So again, looking at that scale, if you're a public company versus private, what are the results? You really need to be a bigger company. If you're going to be public, you need the scale to be able to cover the costs of doing those things. In the US, Congress acknowledged this. They came out with something called the Jobs Act, which is sort of an on-ramp if you're a smaller company, give you time to grow into that. In the UK, there's something similar, the alternative investment market, where you can come onto the exchange, but you have some limitations for those companies. And in Asia, I would say there's not as much of that, but there's certainly a view to looking into, are these problems going to be issues here? So the key question, and I think Mizuna-san is right, is can the CEO and the board focus on the long term, and in that public environment, do they get forced into a more short-term perspective? We do see some companies are choosing to stay private longer, and the unicorn effect. But don't think that that's a free lunch, right? The private equity investors are not asking them any questions. They're demanding reporting. They're actually quite actively involved in many of their businesses. We see some companies choosing to sell themselves to a larger public company, and obviously some of the acquisitive firms, Tencent, SoftBank here in this market, Facebook, Google. And why would you want to sell yourself to them? Well, here's a company that's got scale, that is already public, and you can sell and maybe run your division. So it's not quite like being private, but it's certainly not being in the spotlight and having to deal with all the things that I mentioned. And lastly, and what I want to spend a little bit of time on, is the idea of dual share class listings. So when you look at all this, what have we done is we've driven companies into what is not good for corporate governance, a choice of coming public, but doing it in a way that investors don't have the same rights. And I think we have to really think about that hard, and I know we've had some conversations with people about that. In the US, to give you a sense, there's about 10% of the existing companies are dual share class listed. It's been around a long time. There are some very good examples of dual share class companies. But when you look at the current and forward calendar, the increasing percentage is actually quite stunning and something that I think raises issues. It's not just in the US. Here in Asia, both Hong Kong and Singapore have changed their listing requirements. India has a consultation out, and several additional jurisdictions have indicated that they're going to go forward as well. So what things do we look for? We're looking for investor protections. How can a company come public and be only slightly public? And look just last week at Facebook, many governance issues, and yet investors' voice doesn't really count. The chair in that case has less than 15% economic ownership, more than 50% of the vote. So this is, I think, a current corporate governance issue that really needs to be looked at. But I don't say it's just on one side. It's really taking the holistic view. That's why I started with that scale. If we don't address the issues of what the burden has become on being a public company, we can't really address the desire to end up as a dual share class listed company. Can't have one without the other. So I do sort of throw out the challenge to everybody is we need to address the public-private trade-offs. We need to address the founder rights versus the shareholder rights. And in doing so, I think we need to address long-termism and encourage long-termism. I think you'll find our views are pretty closely aligned. We'd all like to see companies there where we've protected the downside, and in fact, 5 and 10 years out, they're thriving. That's a good outcome. I'm not sure we're set up for that today in the capital markets.
Just a quick question. In your actively managed funds, shouldn't you be boycotting these issues where you're being deprived of shareholder democracy?
I'm not going to go into all the different funds we have because we have so many, but we do make an active decision in part of our business. 90% of our equities are index-oriented, so if it's in the index, we're going to own it.
Okay, well, let's turn now to Carmine di Noia. Carmine, we know that there's been a decline in the number of newly listed companies in many European markets. Do you think that the cost of listing, corporate governance requirements, disclosure requirements, do you think all these are discouraging companies, and particularly smaller and medium-sized companies from going public? And if so, what can be done?
Thank you, John, and thanks for this invitation to OECD, Japan government and FSA, and Masato. And okay, this is a fact. We are having a reduction in the number of listed companies, especially in the US and in Europe. We have today in the world more or less 40,000 listed companies, and only 10% are in the US. And as it was mentioned also before, they're basically, you know, half of what they were 15 years ago. Actually, still the market cap of US listed companies is very big, so it's 35% of the world market cap. But, you know, listings are growing only here in Asia. So basically, you know, half of the listed companies are here and they're growing a lot. It's true that there is a reduction. Actually, it's also true that this could not necessarily be negative. I mean, if you, in a sense, in a good market, in a competitive market, you have entry and exit. If, in a sense, you clean the market, we have a rotation of listed companies, even in markets like, for example, us or many European markets, where the number of companies is stable or in a reduction, the rotation of companies is still, you know, very high. It's true that there are also, and it was mentioned in the bond paper before by OECD, that there are other ways also of financing companies. And it's also true that there are second-tier market, which, you know, are increasingly important, maybe not in absolute terms, but, you know, in relative terms. We have, it was mentioned AIM UK, but in Italy we have a similar market with basically half of the number of listed companies are there and they're increasing. And we have also, interestingly, examples of funding through mini bonds, so issuance by very small companies issuing, you know, 5 million, 10 million, 1 million, which is really a bank loan on the market. This is costly. This is not necessarily for, you know, for funding, but it's going back to the old role of stock exchanges as, you know, sort of ratings. So is a signaling, has a signaling effect. And even so, after these issuance, they get even more bank financing. So okay, we are having a decline overall, but there are interesting, you know, signs and evolution. It's true that, you know, we have a competition by private markets in a sense. It's easier. We have these, I would say, is both a supply and demand, you know, side. We may have that it's easier, let's say, for high net worth individual, for classes of individual, you know, investors to access now private markets rather than, you know, public. But it's true that, and it's a pity that if public markets have a, you know, a decreasing role, then the possibility for, you know, access of retail investors to, you know, to growth, to diversify the portfolio and the growth of companies is you know, is less. So what we should do, keeping in mind that listing is not an end in itself. So we want to avoid, I think, adverse selection, you know, problems that only, you know, the worst companies go there. I think there are, you know, it's true that the perception everywhere is that there are some, you know, burdens that may be considered as such, especially by small companies, and there are, you know, regulatory responses. Maybe some of them, and it was just mentioned by Barbara, like here, easing in a sense, let's say, issuance of dual-class shares, apparently has been, you know, a positive idea in Asia because, you know, if we see the number of IPOs here is there. But there are, I think, different, you know, ways that we can, in a sense, follow. So on the one side, I think there are, let's say, market-based solutions. So, okay, we have to try to encourage, you know, diversification of funding sources. I think we have to try to encourage, you know, firms and companies to really go on the market if I really think is a good idea. So having an entrepreneur education program is something which is very important. We have trying this in Europe, in Italy, and we have this program called Elite. There are more than 1,000, I wouldn't say SMEs, I would say S, that basically they go back to school, but not just for, you know, going then listed in the future, but really to understand how to go to a bank, how to present, you know, financial reports, the importance of basic corporate governance rules, even in a family-owned firm, of related party transaction, basic governance things. So I think this is one way to do things. Then there are, you know, regulatory burdens, and OECD has published that the peer review on flexibility and proportionality is a good way to, an example of having a flexible approach. Now, it's always difficult to find a balance, especially for, you know, for a securities regulator taking care of investor protection. But, you know, when companies are so small, they're too small for big investors. So de facto they are small, and de facto they are, illiquid, and so their securities are more long-term and riskier. But we need to have access to them by individual investors. So regulation, calibration of regulation, prospectuses, market abuse, and so on. But an important topic is to raise interest on these companies, and this is a topic of analyst coverage and research. If we have the dominance of important, players and intermediaries, and we are having, basically, they're not interested in coverage of a very small, company. So we need to find some way. We probably had an intended consequence of EU regulation on this, on MiFID II. We needed to have more transparency on the cost of research, but at the same time, we need some economic incentive for independent research. If they are not, someone should take care. And this someone could be, exchanges maybe, or something should be done in order at least to spread the cost of this kind of research, especially in SMEs. Otherwise, we're going to have the big undercut by cost by, the big US banks are offering coverage on EU companies, but only of the big ones. So, and the third thing is, I think we need, to find also the other side, so to find, investors. So now, how to find, an investor, and in these strange ecosystems. So because we need to have an equilibrium of supply and demand. Okay, we need investor education. People need to understand that investing in these kind of companies is a different asset class. So, and securities regulators or public, policy are not there as an insurance against losses. Okay, we are having interesting signs because we may have indirect access to a very liquid asset. We are having in Europe these new LTIF tag, which are funds that even open to retail could invest in long-term and infrastructure. So this is something that could be done. And in the end, this may really improve overall the possibility of funding for SMEs, which in many countries are really the engine for growth and employment. Thank you.
Thank you. So now let's turn to Ligang Yu. And one thing that emerged very clearly from Mr. Kanda's slides was that with IPOs, the action is very much in Asia in terms of the number of IPOs. Can you tell us what do you think drives Asian companies, especially Chinese companies, to the stock markets? What is that all about?
Okay, thank you. Thanks for the invitation from FSA and also OECD. And it's a great opportunity here to share, China's market development. I would think that the main reason for Chinese or Asian company to tap into the capital market is to diversify the funding sources so as to support fast economic growth. We all know that in Asia is the fast-growing area globally, and China contributed over the last 10 years, perhaps on average 30% of global growth. And so at the same time, you can see that the Asian financial structure is inadequate to support this very rapid growth. We all know that in Asia, the financial system is bank-dominated. Banks' financing tend to be short-term, quite expensive. In the case of China, private firms have a great difficulty in accessing financing. Last year, we have seen that quite a lot. A lot of private companies went bankrupt, and because of the financing issue, the overall growth has been affected substantially. So in order to address this, I think it's natural for them to tap into the capital market. And I want to mention that in addition, I think this bank-dominated financial structure has also its deficiencies in financing, emerging startups and high-tech corporations. And so we all know that, for those new companies, They don't have a track record. They don't have tangible large capital. So it's very difficult for traditional banking evaluation methods to assess the potential of those new companies. So that's the reason I think down the road, the capital market probably will be the important driver for Asian growth and China's growth. Here, let me tell a little bit about what China has been doing over the last few years. We all know that China's capital market is fairly closed for most of the time. But until 3 years ago, the government more or less made a decisive plan to open up its capital market for foreign participation while keep its capital account liberalization cautious. I think this is a right sequencing strategy for China because given a lot of corporate governance issues and also the size of the market, and if China were to receive large capital inflow and outflow, it's very likely to see some kind of banking or financial stress or even crisis. So keeping capital account relatively closed while keeping the markets more open for foreign participation, that will encourage capital, orderly flowing capital and orderly exit of capital. So that's something we will see more in terms of China's financial market structure. Perhaps the big development down the road is increased foreign participation in the Chinese capital market. 2 years ago, in 2017, MSCI more or less made the decision that China's Asia can be included in the MSCI Emerging Market Index. Last year, they decided to include around 222 Asia, Chinese Asia large cap stocks. And this year, the formal implementation has started. Then the weighting share could continue to increase from the current 5% to 20%. In the end, perhaps given the size of Chinese equity market, already the second largest in the world, it's not difficult to imagine that China could have 40% of the MSCI share. So you can see that with more foreign participation in China's capital market, we tend to think that Chinese corporate governance could gradually converging to the global standard. Coming here, I also read the OECD 2019 fact book. One thing about Chinese corporate governance code is that it is mandatory. That code has been updated last year, and it is mandatory for all listed companies to follow that code. And so you can see, in terms of the legal requirement, the standard is very high. In addition, China has been promoting green finance, and the ESG standard has been highly promoted. But in terms of implementation, indeed, there's a great room to improve. And it hoped that with more foreign participation, especially foreign institutional investors like BlackRock and others, will increasingly demand for higher standard of corporate governance, so that down the road, Chinese onshore market won't be a very volatile market, as our colleague mentioned, and also it could be a real value investment platform for not only Chinese savers, but global investors alike.
Thank you. On that point, perhaps I could turn to Hiro Mizuno. The enormous increase we're looking at potentially of Chinese companies in the MSCI Emerging Markets Index. I mean, your passive funds within your portfolio are going to find themselves much more exposed to a lot of Chinese companies, many of them state-controlled, a lot with rather poor standards of corporate governance. How do you feel about that?
Well, I'm not going to make any specific the comments on each Chinese companies, because first of all, investment equity, investors should make a decision by company by company. I mean, that's I think the rule of thumb. To begin with, investors have to make a decision on each companies. But that's why we have been giving the flexibility or liberty to our active manager to invest into Chinese equity market for the last several years. But so far, we haven't seen much pickup from our active managers. And all of a sudden, some index provider decided to include the Chinese A-share in the index. All of a sudden, everybody make an investment. That's actually, I don't feel very comfortable. I think the people who are making more active pricing judgment should be in a better position to make a judgment in those kind of the decision. But as a reality of the market, now the index provider became very, very influential. And BlackRock is our biggest asset manager, but in a way, MSCI probably de facto our biggest asset manager because they dictate what we ended up owning. So I think that when we look at the market trend to have more and more the passive manager or passive investor became significant in each market, and particularly in the emerging market, I actually wanted to encourage active investor to stand up and to step up to make a more active decision on their investment. So we have both active and a passive mandate. And a passive mandate, we request the passive asset manager to become more active owner. So I think the BlackRock and other passive manager engage with the company on those ESG issues. And we also consult with the index provider on the actual decision whether they should include some particular market or some particular company. And we discuss a lot with the index provider on dual non-voting share issues and also China issues. But those are the significant agenda that the asset owner should more seriously engage with the manager, also the index providers. But that's how the market is developing, and all the stage actors have to be responsible to support those. But only the one last thing I want to mention is, I always think ESG factors are even more relevant for the companies and the government in the emerging market, because we have less confidence in sort of the other business customs in those markets and also regulatory framework. So the individual governance and environmental social, consideration, we think is much more relevant with the companies and the governments in the emerging market.
Thank you. We're close to time, but a quick one for Barbara, if I may. You touched on this issue that Mr. Kanda raised of the tech giants that are buying up small, potentially competitors to them. There's a real competition policy issue here, isn't there? Do you think that competition policy can and or should be tightened to address that particular issue?
So I think there's two different issues. Some of the acquisitions that are done are actually to diversify the offerings that the company has. So I don't think you can bucket everything in one category or another. You have to look at the incentives of the companies who are selling and why are they selling. And I come back to understanding really holistically what burdens we've put on being public And if we want to even that playing field, I think you'll see more of those small companies choose to stay independent and choose to compete in whatever their product is. Today, we don't have that level playing field. We've given an incentive to either stay private longer, sell yourself to a larger public company, or if you do go public, to do it with a dual share class. I think we need to rethink how that looks.
Carmine, do you want to add to that?
Actually, dual class, we could speak for the next 10 G20 meetings, but I think in some cases, especially when you have, SMEs, family-owned companies, we want to incentivize, listing and transparency, because transparency is the best of disinfectants, as Brandeis was saying. We need to try to calibrate, regulation, give incentives. We have interesting examples in Italy of, companies introducing some loyalty shares. We have the new exchange in the US. They want to, in a sense, give awards to long-term shareholding. So I think we need to incentivize, companies to go on the market. Maybe using also technology, the very just quick thing. Everyone is talking about blockchain. If we place securities using technology, we may save a lot of costs for company, and this could maybe destroy some industry, but could be beneficial for everyone. Thank you.
Gang Liu, we have 1 minute left. Would you like to have a final reflection on our conversation?
Yeah, that's a very interesting session. I wonder, when I read a lot of numbers provided by Kanda-san, and one thing is that if you look at the potential of the Asian and the Chinese equity market, it could be huge down the road. Last year maybe it was quite an Euro year. Chinese equity market hit by both the lack of domestic confidence and the external shock. So there's a very limited listing. But if you then look at Chinese equity market, the list pipeline, it is huge. And also the government is going to engage so-called supply-side financial sector reform, and with a high priority to encourage capital market development with the aim to support more of technology innovation and to create a more unicorn in the Chinese equity market. And this innovation and technology board will use approval system rather than the current. We'll use a registration system rather than the current approval system. And so you can see that down the road, there could be more Chinese high-tech companies emerging from that. Also, I want to mention that it's unfortunate the current trade negotiation breakdown has affected the global investor sentiment on the Chinese equity market. I think this is just a short-term issue. If you look at longer-term potentials of the Chinese economy, the second largest already for global investors, especially a lot of investors in this room, in order to tap into China's high growth and getting into China's capital market to invest, perhaps will be a must down the future.
Thank you so much for bringing things to a very elegant close. First of all, our thanks to Mr. Kanda for setting out the ground very helpfully for us all, and thank you to our panelists for packing so much into a relatively short session. We leave much wiser than we came in. Thank you.
Thank you very much, Chair, Presenter, and panelists. You may return to your seats now. Thank you very much. To end the seminar, Commissioner Endo will deliver the closing remarks. Let's welcome him with a big round of applause.
Thank you very much for the fruitful discussions. I had a number of inspiring ideas in the two sessions. In session one, national regulators and international bodies shared their experiences and achievement based on the 2015 G20 OECD corporate governance principles. These input will be a great reference source for policymakers to enhance corporate governance, even though there are regional and country differences in market structure and economic environment. As Minister Aso and Mr. Inoue noted, corporate governance reform in Japan has achieved remarkable results. Within just 5 years, we have seen significant changes in company behavior. However, we are not content with these results. We are continuing our reforms focusing on substantive issues. These include ensuring that the quality of decision-making continues to get better, and that improved communication between investors and management leads to an exchange of new ideas and approaches, as well as better outcomes for Japanese companies. Enhanced disclosure, including of non-financial information, would help facilitate constructive dialogues between investors and companies. We have made some progress in encouraging companies, in particular their senior executives, to actively disclose management direction and strategy. We are also considering further revision to our stewardship code and look forward to deepening our reforms based on the ideas shared by today's speakers. In addition to our work here and at home, Japan is also promoting the global dissemination of good governance practices. These efforts are focused on Asia, and in cooperation with the OECD, the Asian Roundtable, co-hosted annually with the OECD, is a great opportunity to bring together government officials, academic, and practitioners to build a network for sharing experiences, knowledge, and best practices on corporate governances. We are also carrying out projects bilaterally in Myanmar and other countries to help them establish corporate governance frameworks suited to their local conditions. We are determined to keep helping enhance corporate governance in Asia through these projects. Improved corporate governance in emerging economies is, in fact, good for all countries. For emerging countries, it increases their access to global capital. For developed countries, it expands the number of investment opportunities in fast-growing markets. In the end, this leads to a more efficient global allocation of resources and a wider societal sharing of the benefit. In session 2, we had an insightful discussion on the challenges we face given structural changes in capital market. Global markets have evolved markedly over the last decade, as shown in the OECD's interesting analysis. As one example, in the past, startups set an IPO as their business goal. More recently, the number of listed companies has declined in some advanced economies, with many startups now looking to be acquired rather than choosing to go it alone in an IPO. Equity market provides societal benefit by making a broad range of public companies available to investors, including households, who can benefit from companies' growth. So we have to ask ourselves the question, can public market continue to be attractive enough for both companies and the global investors? What can we do to achieve this? This session underscores the common issues that we will need to consider now and into the futures, as well as new insight to help address them. Another important change has been the shift from active to passive investment strategies. Asset managers once competed for investor fund for higher alpha. However, as it has recently become more difficult for them to earn excess return from active investment strategies, the preferences of institutional investors have shifted toward passive management, accelerated by the growing presence of such investors, passive investment is now set to account for the vast majority of managed funds. Asset managers of passive investment are expected to keep fees low while not having the option to exit specific assets. This means that they have stronger incentives to promote the longer-term growth of the companies they invested in. This highlighted the value of promoting engagement between investors and companies. While this approach may sound simple, it is an important and practical way for asset managers to deepen knowledge of their investee firms and to exercise voting rights in ways that will lead to long-term corporate growth. Now, more than ever, we are likely to face common challenges in corporate governance given the highly integrated nature of global market. It will be only more important that we share our experiences and our understanding of the issues and promote collaboration of the kind we saw today. Thank you very much.
Thank you very much, Commissioner Endo. This concludes today's seminar.